A. Demonstrate understanding of the impact of foreign exchange rate changes on financial statements. Foreign exchange rate fluctuations affect both the balance sheet and income statement when a company operates internationally. Revenues and expenses denominated in foreign currencies must be translated into the reporting currency, causing variability in reported sales, costs, assets, and liabilities. Even if underlying operations remain stable in local currency, exchange movements can significantly alter consolidated financial results. Accounting for foreign operations involves historical versus current rate translation methods. Under the current rate method, assets and liabilities are translated at the closing rate, while income statement items are typically translated at average rates. Translation gains and losses are often recorded in other comprehensive income. Under the temporal, historical rate method, certain items remain at historical exchange rates, and gains or losses affect current income. Functional currency is the primary currency of the foreign entity's economic environment. It is the currency in which the entity generates and expends cash. Determining functional currency guides which translation method is applied and directly affects where translation adjustments are reported. Exchange rate changes influence financial ratios. For example, depreciation of the foreign currency may reduce translated asset values, affecting ROA, leverage ratios, and turnover measures. Analysts must isolate operational performance from currency effects to avoid misleading conclusions. Volatility in reported earnings due to currency fluctuations can affect management decisions and investor behavior. Managers may adjust hedging strategies, financing structure, or operational sourcing to mitigate risk. Investors may react negatively to earnings volatility, even if core operations are stable, impacting stock valuation and perceived risk. B. Demonstrate understanding of the impact of inflation on financial ratios and their reliability. Inflation distorts historical cost financial statements, reducing the reliability of ratio analysis. Assets recorded at historical cost may be understated relative to current replacement cost, which can artificially increase return ratios such as ROA and asset turnover during inflationary periods. Income statement effects also occur. Depreciation based on historical costs understates current economic expense, potentially overstating profit margins. Similarly, inventory valuation methods, e.g. FIFO, may produce higher reported income during inflation. Liquidity and leverage ratios may be misleading. Asset values may not reflect real purchasing power, and debt recorded at nominal amounts may appear less burdensome in real terms. Analysts must interpret ratios in inflation context. Adjusting for price level changes improves comparability across periods and enhances the reliability of performance evaluation. C. Adjust financial statements for changes in accounting treatments and assess ratio impact. Changes in accounting principles, e.g., inventory method changes, typically require retrospective adjustment. Prior period financial statements are restated to ensure comparability, affecting trend and ratio analysis. Changes in accounting estimates, e.g., useful life or bad debt estimates, are handled prospectively. These adjustments affect current and future earnings without restating prior periods, impacting profitability and return ratios going forward. Correction of errors requires restatement of prior financial statements. Failure to adjust may distort growth trends, margins, and leverage measures. Analysts must carefully review disclosures. Adjustments influence comparability and may significantly alter liquidity, profitability, and solvency ratios. Understanding these impacts ensures accurate performance evaluation and prevents misleading conclusions. D. Distinguish between book value and market value, and between accounting profit and economic profit. Book value represents the historical accounting value of assets and equity recorded on the balance sheet. Market value reflects the current value investors assign based on expectations of future cash flows and risk. Market value often differs significantly from book value. Intangible assets, growth prospects, and risk perceptions influence market value but may not appear in accounting records. Accounting profit is net income calculated under accounting standards. It reflects revenues minus explicit expenses recorded in financial statements. Economic profit considers opportunity costs and required return on capital. It measures value creation beyond the cost of capital and provides a more comprehensive performance assessment. Understanding these distinctions enhances valuation analysis and strategic decision-making. E. Identify determinants and indicators of earnings quality and explain their importance. Earnings quality refers to the sustainability, reliability, and transparency of reported income. High-quality earnings are supported by strong operating cash flows and recurring business activities. Determinants include revenue recognition policies, expense estimation accuracy, and accounting method choices. Aggressive accounting practices may inflate short-term earnings but reduce long-term credibility. Indicators of low earnings quality include large accruals, significant non-recurring gains, frequent accounting changes, or substantial earnings volatility. High earnings quality improves investor confidence and valuation stability. It enhances the usefulness of financial statements for forecasting and reduces risk perception among creditors and investors. Assessing earnings quality is critical for distinguishing sustainable performance from temporary or manipulated results.